You're listening to The Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hey everybody, last time we talked about whether or not you should be selling or buying stocks right now, and today we've got another NERDvember episode for you, and we are discussing the topic of how do I know which investments to buy. Now, before I get into it, some housekeeping items as always. If this is your first time listening or watching, then thank you for joining us. I'm Adam Koos, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group, coming at you from the friendly Midwest right here in Columbus, Ohio. Be sure to subscribe on YouTube, iTunes, and Spotify so that you're the first to get these episodes. As an added bonus, if you're interested in getting our custom-made articles, screencasts, and other free financial education, head over to libertaswealth.com and either click on the button at the very bottom of the homepage to get your free report on the top 5 questions to ask when searching for a financial advisor, or you can just simply shoot us a message on our contact page and you'll be added to our inner circle and kept in the loop on all new educational material that comes out right when it's published. You can follow us on Facebook at facebook.com/LibertasWealth. We're on Twitter or X or whatever they call it these days, which is twitter.com/LibertasWM. And you can also follow me personally on Twitter at Adam Koos, which is at Adam Koos, as well as on Instagram at Adam DKOOS. Most importantly, if you'd like to schedule an intro call to confidentially discuss your financial situation in more detail, or if you'd like to get a second opinion on your retirement plan and or investment portfolio, head over to our website at libertaswealth.com and click on that button in the middle of the homepage that says, see if we're right for you. And if you do that, somebody will reach out to you to get something on our calendar. Last but certainly not least, all links, visuals, charts, and other educational resources are available on our website, and we are going to have some charts and visuals today. So if you listen to this on iTunes, I'll do my best to talk through it, but it probably would help to go back and look at the charts visually in the future. So let's go ahead and jump right into it here. Again, the topic is, how do I know which investments to buy? And I put a little subheading here that there are many ways to invest. You just have to pick a method that works for you. In other words, there's a lot of different ways to do this the right way. I wouldn't say that there's any necessarily a best way. Instead, I would say the best way is the way that works best for you. So I always like to do a quote of the day. And today our quote is from one of my good friends, one of my early mentors in the business of portfolio management, Tommy Dorsey. Tommy founded Dorsey Wright and Associates back in the 80s, I believe it was. And he sold it to NASDAQ back in the mid-20-teens for a healthy lump sum. He is, I wouldn't say he's retired. I'd say that he's still doing his TA work. He's still doing portfolio management work. He's still a passionate technical analyst. And, he and I were just talking, actually, doing a little Zoom meeting in our backyards over the fire, discussing the markets a couple months ago here. But Tommy said this best, I think, when it comes to education and some of this nerdy stuff. Again, it is NERDvember. So he said that if you can't explain it to a 6-year-old, then you don't understand it yourself. And I think that speaks to other quotes that we've seen in the past about education, which is you've got to be able to explain it in a simple way, and that shows that you really know what you're talking about. So that's my goal. I know we call it NERDvember. I know this is all technical stuff, but my goal is to make this understandable for even the most novice investor that's just getting started. So today we're talking about, again, how do we know which investments to buy? I use at our office primarily, or I should say the foundation of how we decide what investments to buy is based on something called relative strength, or RS for short. Relative strength has almost everything to do with what's something called momentum. It's Newton's law. An object in motion will stay in motion until acted upon by an equal or opposing force. And when investments are in motion and when they are moving at a momentum or a velocity that is outpacing their peers or the market for that matter, they tend to stay that way for a while. It doesn't work every time. If it were, it would be easy, right? And it's obviously not easy. I always say it's simple, but it's not easy. But the point here is that when you invest in investments that have momentum, then there is a high probability, or at least an edge, that you get by investing in those high momentum investments that keep you on the right side of the trade, or in other words, keep you investing in the trend. So if we talk about what relative strength is, Let's use some analogies here. What's the best time of year to buy strawberries? Is it in the winter? Probably not, right? So the best time to buy strawberries is when they're in season. That's going to be when they're cheapest. It's going to be when they're freshest. It's going to be when they haven't been shipped, at least here in Ohio anyway, or anywhere else in the Midwest, when they haven't been shipped from 7 states away. And who knows how long it took between the time they were picked off the stem to where they show up in your grocery store. So that's the best time, and that's about seasonality. And the market has seasons, right? The market has good seasons, it has bad seasons, and so do investments. They go through uptrends, downtrends, and sometimes they're just trendless. Another analogy, which is faster? Think about this. Which is faster, one runner on a track who runs 1,600 meters all by him or herself, or 4 runners on a 4x400 meter race passing the baton each lap to someone new with fresh legs? Obviously, that's going to be the 4x400 meter race. For those of you that are listening or watching and you're engineers, you're probably thinking, well, what if it's Usain Bolt? Okay, we can split hairs, but conceptually speaking, I think you understand what I'm trying to say. Maybe Usain Bolt with shackles. Anyway, when predicting which students are most likely to attend college, would you not focus first on the honor students? Think about that for a second. And I'm sorry I covered this up a little bit. I deleted my little videos placeholders, so I accidentally covered this up. But what it says here is if you had to invest your nest egg, your life savings, in the March Madness basketball tournament, in other words, if March Madness was the market, the stock market, the bond market, the commodities market, would you spread your money across all 120 plus teams in the March Madness tournament, or would you just buy the top seeded teams, the top ranked teams? And if you're somebody who's really thinking about this right, you're probably going to say you would probably focus on the top seeded or the top ranked teams and avoid the bottom seeded teams. So that's a little bit of some analogies and examples of what relative strength is and how it works. Now, one of the reasons why relative strength is so important, and not just relative strength, but trend, is this right here. There's more than these, by the way. We've got CitiGroup is what we're looking at right now, a chart of CitiGroup. And we could look at Bear Stearns, we could look at Lehman Brothers, we could look at Eastman Kodak. So there's several stocks, Enron, WorldCom, over the years that back in those days, people said there's no way this thing could collapse. There's no way it could ever go down. But back during the mortgage crisis, a lot of stocks went down. Some went to zero and never ever came back. Now, CitiGroup ended up being one of the companies that did come back and ended up coming to new highs and ended up becoming a very, very strong company, a very financially strong company. But back in 2007, 8, and 9, that wasn't the case. And when you look at fundamental analysis, companies like Prudential in early 2007 said that you should overweight Citigroup stock. As the stock price started going down from 500 to 450 a share, Bank of America says, well, it's an even better value now, so you should buy it now. So they stuck their recommendation in as a buy. After the price fell down to about $300 a share, so it's fallen almost in half at this point, Punk Ziegel and Company says, now you should buy it. And then it goes down more than 50%, and Sandler O'Neill, they don't say to sell it, they say now you should hold it. And that's after the stock's already gone down 50% from its highs, more than 50%. So as you can see here, the stock continued to go down until it hit, lower than $11 a share. But this is an example of what can happen if you stick with a stock based on A, fundamental analysis, B, value investing, trying to get a deal, or just, it's lower now, so I should buy it. In other words, the bottom of the chart is not zero. It can keep, if you go down from 500 to 250, you lost 50%. You can lose 50% again, going down to 125, and you can lose 50% again from 125. So you can keep losing 50% over and over and over again until obviously it hits zero. I'm not trying to be a doom and gloomer here. I'm just trying to make the point that investing in the playoff teams, investing in high-ranked stocks, and avoiding the low-ranked stocks is probably an advisable investment strategy. When we look back to 2009, there's this really, really interesting article that came out, and this was after the bottom of the market hit. And I have this little quote here. Why is it that mutual funds say that you should never sell? Buy, hold, stay the course all the time. Never sell your investments. Never make changes aside from rebalances. And the reason why is because they don't get paid if you sell, right? So you have to be invested in order for them to make money. Now, I know that's probably pretty cynical, and I apologize if that sounds too cynical, but the fact of the matter here is that we need to protect our money, and we need to stay invested in the winners, and that's what relative strength is all about. So the New York Times said, this is an article in the New York Times, it said, at the top of the market, analysts urge investors to buy or hold stocks about 95% of the time. When stocks stumbled, they remained optimistic. Even in November of 2008, when credit froze, the economy stalled, and the financial markets tumbled to their lowest levels in a decade, analysts as a group rarely said sell. And this was in the New York Times, February 9th of 2009. So very, very interesting that you're going to get buy, you're going to get accumulate, you're going to get hold, but you're not going to see too much in terms of reduce or sell. It's just, it just doesn't happen. I don't want to get into all the reasons why or the theories as to why that might be. It becomes very controversial, and I don't want to do that. I think I've already been cynical enough. So we'll just move on here. Okay. So there's lots of ways to skin a cat. There's lots of ways to do this. One thing we could do is we could just put together with something called a relative comparison chart. This is a relative comparison chart of the S&P 500 in the dark black here. And for those of you listening, what we're looking at is just a relative comparison chart of the different sectors in the S&P 500 over time compared to the S&P. And this chart in particular says, we've got the consumer discretionaries ranking above the S&P, technology, and then communication. Everything else, for the most part, is ranking below it. Now, does that mean you shouldn't own any of those sectors? No, it doesn't, because all we were looking at here is a snapshot in time, which just happens to be 12 months. It's a 52-week rate of change, essentially. So this is what I would call good information, and it's interesting, but I'm not so sure how actionable it actually is. And by the way, it could be actionable. This could be your strategy. What I want to do is I want to stay invested in the top ranked, or in other words, the sectors in the U.S. market that rank above the S&P over a 52-week rate of change. And whenever I look at this every week, if something falls below the S&P, then I buy whatever's above it and sell whatever's below it. That could be a strategy, I suppose. For me, personally, and with our models at our office, I like this. This is again good information, but it's not necessarily something that I think would be the best system for us anyway. I would want something a little bit more robust. So if we go, and time frame too, by the way. I know the last podcast we did in this NERDvember series, so go back to our YouTube page, iTunes, check it out. The first one was most important. You can't even, if you're actually going to use this for your own money and your own portfolio management, you have to start with the first one, which is all about time frame. And that's another issue I have with what we were just looking at on the prior screen, is the rate, and that rate of change sheet is time frame. I use an intermediate term time frame in that one before, maybe a little bit too long term for me. I'm also not short term. I'm not a swing trader, so I'm right smack dab in the middle. That's where I'm happy. That's what I like it. That's what I've tested. It works for us. It works for our clients, and that's what we do. So what you need to do in your portfolio is you need to have a time frame, and you need to have a strategy that matches your personality profile, if you will. Because obviously, in your case, if you're watching this for your own money, you're doing this just for you. All right, moving on. So this is a relative strength chart. And what this is just comparing one type of investment to another, and that's it. So what we're looking at here is not a chart of large cap stocks. You can see up here it says large cap stocks versus small cap stocks. So we're not looking at the S&P, and we're not looking at the small cap index. What we're doing is we're looking at a comparison between the large cap index and the small cap index. I used IJR. So when the chart is going up, and I threw a 150-day moving average on here, by the way, so it's a 150-day trend. I think it's Steve Setmeyer used this, and I thought it was really neat, so I just used the same thing. But 150-day moving average and it just, ironically enough, happens to kind of touch these bottoms here, which is not a coincidence, by the way. But anyway, if it's trending up, that means that large cap stocks are outperforming small caps. If it's trending down, that means small companies are outperforming large company stocks. If it's kind of flat like it is right here in 2022, that means there's really not too much outperformance on either end. It just means it's kind of, the comparison is relatively trendless. In other words, it'd be pretty hard to decide who's outperforming, large versus small here. So the reason I put a 150-day moving average on it, or this 150-day trend line, is it makes it a little bit easier to see where the pivots are, where the change in trend occurs. And you can see here, if you were just going one or the other, you'd be whipsawed to death and chopped to pieces trying to pick which one's the strongest here between, we'll call it, fourth quarter of 2021 and beginning of 2023. So 2022 would have been a rough year. But here you can see since the beginning of 2023, large cap stocks have been outperforming again, with small cap stocks lagging. So that's one example. Here's another one-on-one chart, and this one's looking at large cap stocks, so large company stocks versus bonds. So we might be asking ourselves, well, how do I know which investment to buy? Well, do I want to buy stocks or bonds, or do I want to overweight stocks or bonds right now? When the chart is trending up, that means the denominator is doing better, so the large cap stocks. The second name here, the numerator, would be if it's trending down, that means bonds are doing better. So going back to late 2020, you can see that large cap stocks outperformed the bond market right up until about the beginning of 2022. Then again, it was pretty much flat. You could argue it's not flat at all. It's choppy, right? I'm looking at the 150-day moving average just kind of flattening out and not really going much of anywhere until the beginning of 23. So then it started going up again. And that's because, by the way, the reason it was flat is because bonds went down and stocks went down, which was why 2022 was such a terrible year for the market, because if you look at the average balanced portfolio, which would be 60% stocks, 40% bonds, you'd be looking at a performance of somewhere in the ballpark of, I think it was down 34% that year. And it's not just because stocks went down, it's because stocks and bonds were both hammered. So here, right now, since first quarter this year, unequivocally, stocks, S&P 500, large cap stocks, outperforming bonds. Here, I've got one more one-on-one stock, and this one's just, this is for the current events folks. This is for the people who maybe like to read a little bit. They see things in the news. They watch commercials. This is Novo Nordisk, who makes a lot of what's called semaglutide, which is the main agent or chemical or drug in Ozempic and the other weight loss drugs that have been approved by the FDA recently. And so somebody might say, well, I know Novo Nordisk makes this, and I know Eli Lilly does too. Which one makes sense? Which one should I buy? And again, Novo Nordisk is the denominator here. So if it's trending down, then that means Eli Lilly would be a better stock to own than Novo Nordisk. If it's trending up, then Novo Nordisk would be the better stock. So you can see here, if I just point my finger at fourth quarter of 2022, since then, crosses above its 150-day trend line, and it stays pretty much up and peaks out almost at the same place on this relative chart as it did in fourth quarter of 2021. And then it just kind of heads down, and since, call it, I'll say April, May of this year, it's really, really been a better place to be in Eli Lilly thus far. So this is, again, you could do Pepsi and Coke. You can pick any stock you want. But the problem with it is it'd take a lot of time to go through every single investment in the sun, whether that be individual stocks here in the U.S., stocks overseas, regional country stocks, commodities, bonds. To try and rank everything would take hours daily to try and do this in a way that's actually actionable. So I put up here, is this good enough? And the answer is no. At least if you have a job and you don't do this for a living like we do. So, well, even though we do this for a living, this is what we do at our office. We can build ranking systems, and we can do it in many ways. This is just a 26-week rate of change, which is, it's my time frame, intermediate term, about 6 to 12 months. Kind of focused more on 6. But you can see here, if we look at the S&P 500, all the stocks in the S&P 500 here, doing that ranking system, you can see Adobe is the number 1 stock, NVIDIA, Vornado, Arista, Constellation Energy. They can keep going down here. Zions Bancorp, Broadcom, Westrock Energy, Meta, Synopsys, ServiceNow, Eli Lilly, Western Digital, Halliburton, United Rentals, and so on. That's the top of the list. That's the top decile, and that's not the whole top decile, obviously. But we can go to the bottom of the S&P 500 and see what's in the basement. And the basement looks like this on the right here. Smuckers, Hershey, Tapestry, Target, Walgreens, Etsy, Align Technology, which is Invisalign, Paycom, which is a payroll company, Albemarle, Dollar General, Moderna. Can't believe Moderna's at the bottom. I guess nobody's buying those vaccines. Anyway, Illumina. Maybe they're buying Pfizer vaccines instead, because I don't see Pfizer anywhere, but that's pretty That's surprising, actually, to see Moderna so low. But Lumen Technologies, Advanced Auto Parts, Enphase, and then SolarEdge is in the basement. It's the worst stock in the S&P 500 right now as of today. So we can rank things by decile that way. We can also rank countries. So I mentioned earlier countries, regions outside the U.S. If you don't know this, since from 2009 till now, with a very, very short period of time earlier this year, and we're talking 3 to 6 months was all, the U.S. has been outperforming all other countries for the vast majority of the last 13 or so years. And as a result, it's really not made a whole lot of sense to put too much money, or in other words, to diversify too much money outside the U.S., because doing so just hurt your portfolio, or at least caused your portfolio to lag. So as opposed to just having a sleeve in your pie chart that's allocated to international just cause, I don't believe in just cause. So what we do is, if it makes sense, which it's made sense to have more invested in international earlier this year, later this year, not so much, to have a small amount, because we haven't seen the rankings completely eject international altogether. But it's made it. There's going to come a point here in the not too distant future where if the U.S. dollar continues to strengthen and break out, we might not have any point in owning international again. Just like there hasn't been much of a point of owning international stocks from 2009 until, call it, 2022. Now, from 2003 to 2007, international was kicking butt. I mean, that's where we wanted to be. Overweight international. That's not the case right now. But if it were, then what we might want to do is we might want to rank the countries and regions overseas. And this is a big, huge inventory of all kinds of countries around the world outside the U.S. and how they currently rank. So you can see here, this might surprise the hell out of you, but Egypt is number one. We've got Poland, India, Greece, Turkey. That's the top decile. The bottom decile, Nigeria, Hong Kong, Thailand, Middle East, obviously, that's not a surprise. Chile, and this global wind energy is not really a country, but it's an international wind energy position. So easy for me to say. So anyway, so relative strengths works with anything we want. We can rank anything under the sun. So let's look at let's remove time. This is a fun one. This is we were just talking about this to a client who's pretty sophisticated this past week, and I built this for him, so I thought I might use it in this podcast. But this is a point and figure matrix ranking system, and what we're looking at here is the NASDAQ 100 and a ranking system that completely eliminates time. And what I mean by that is point and figure charting does not have a time frame, or I shouldn't say it doesn't have a time frame, but it's not like a normal chart where you're looking at a daily chart or a weekly chart or a monthly chart. Point and figure charting doesn't care what month it is. All it matters is whether or not a stock is going up or down relative to the market or its peers. So if everything held constant, if no stocks changed in price for a whole year, a point and figure chart ranking system would not change because the price didn't change. So what this does is it takes that element of time out of it to look at just price differences, and that's a really, really pure way of ranking price differences and momentum and relative strength of stocks and ETFs. So you can see here in the NASDAQ 100, we've got the top ranked stocks on a point and figure basis. And here I circled the ones that we own right now, by the way. So this is just full disclosure. PDD, Constellation, Adobe, Meta, AVGO, Broadcom, Palo Alto Networks, Cadence Design, Charter Communications, NVIDIA, and then Atlassian. So in this system, when it falls below 1/3 of the inventory, which would be 34, which is why this is in a red. I think it's in red. I'm colorblind, so I hope it's in red. Otherwise, I'm just embarrassing myself. But anyway, then if the month ended, then we would eject this position and we would buy whatever's at the top that we don't own. And right now, we don't own CrowdStrike, so that would be the position we would buy. If two of these were to be ejected and fell too far out of ranking, we would buy CrowdStrike and Zscaler. So that's how that ranking system would work. Here's another one and we're going back from bottom to top almost today. So if we started way at the top and looked at from an asset class standpoint, the asset classes out there, every investment you could possibly buy in the world can be boiled down to 6 different asset classes: commodities, international stocks, domestic stocks, cash or money market, foreign currencies outside the US dollar, and then bonds. And if you look at a point and figure ranking system, you can see how when time is eliminated, how you get a different ranking, slightly different ranking system than you do with using more of a long-term ranking system with a traditional chart. Again, using those relative strength charts to compare them to each other. So the point and figure asset class ranking system right now has commodities at the top, which is largely due to the fact that there's been trouble in the Middle East, supply and demand, kicks up the price for oil and other commodities, and that's why commodities are up here, with international stocks being second, domestic stocks being third, then cash, foreign currencies, and bonds in the basement. What's interesting here that I did not put down, by the way, is that commodities, international stocks, and domestic stocks, this is the ranking currently, first, second, and third. But if you look at the actual guts of the ranking system, they are so close to one another that they might as well be tied. Not literally tied, but so close that I wouldn't be sitting here going, well, we need to get rid of domestic stocks because commodities are doing so well. It's not like that right now. They're so close together that really commodities are up there again because of what's going on in the Middle East. But I don't know that this is necessarily something you should look at and then turn around and go to your computer screen and start selling all your stocks and buying commodities. Just want to point that out. If we look at the long-term ranking, using, again, traditional charts, relative strength charts, international stocks would be number 1, domestic stocks number 2, cash is number 3, commodities would actually be 4, foreign currencies 5, fixed income or bonds in 6th place in the basement again. So a common theme here is that international and domestic stocks are in the top half on both of these ranking systems, and then currencies and bonds are in the basement on both these ranking systems. Those are the things we want to pay attention to. Bonds have been in the basement for like 3 years at this point, which is why it probably hasn't made a lot of sense to own many, if any, bonds. And if you own bonds, short-term bonds, we're talking ultra short-term, 1, 2, 3 month treasury bills. That's it. There's been opportunities out there. We've taken one of them. It didn't work out. So it really hasn't made a whole lot of sense to dip our toes into the bond market for quite a while now. And until the Federal Reserve, Jerome Powell, stops hiking rates, that's probably going to be the case for a while. All right. Now, if we put this all together here, and we're talking about using relative strength to build a portfolio management strategy, the first thing you need to do is what we talked about on the first episode of the NERDvember series, which we briefly talked about risk. So you need to do a risk assessment, or better yet, you need to have a financial plan. Your risk assessment tells you how much risk you're willing to take, and your financial plan tells you how much risk you need to take. Which one's more important? Should be obvious. The financial plan is what you need, so that should be more important than what you want or what you're comfortable with. However, the number one reason why retirement plans fail is because investors or clients basically throw their hands up and they abandon their financial plan. Well, why did they abandon their financial plan? Because the risk that they were taking in the market or in their portfolio was too high for their comfort level, and as a result, something happened in the market, freaks them out to the point where they're like throwing their hands up and they can't take it anymore. I want to sell everything. Let's just go to the bonds. Let's go to CDs. Let's go to cash. So while a financial plan is the absolute Bible when it comes to a retirement plan, risk is important. Your behavioral psychology is important, and making sure you have a portfolio that fits you is extremely important. The second thing you need to do is create an allocation that marries the output of your plan, your financial plan, with your behavioral and emotional ability to take the market, principal, and interest rate risk. So I pretty much said that a second ago. So the allocation that you put together, and that means what percentage of stocks in the U.S., international stocks, commodities, bonds, cash, that allocation, that pie chart you build has to match your plan and your risk assessment. Then you need to construct rules for each sleeve. In other words, each area of that pie chart, each strategy you put together comes together to make a model. So you might have a domestic stock strategy, you might have an ETF strategy, you might have a bond strategy, and all these different sleeves make up a pie chart or pieces of that pie, and you need to have rules for each of those pieces of the pie. Once you have your time frame, you can combine those sleeves to create your model, and that's what your model is going to be. It's going to be how you invest your money. And then you have to implement your rules consistently and without fail. And I can't remember who said this a long time ago, so I apologize if somebody listening, or maybe it was one of my mentors that originally said this, and I can't remember who you are, so I apologize. But if the quote is, if you don't follow your rules, then you don't have any. So it's common like the quote, if you've ever heard the quote, if you have more than 3 priorities, you don't have any priorities. Similar story here. If you don't follow your rules, you don't have any rules. So with that all being said, that's going to finish up our podcast for today. We hope you learned something. Again, check out the podcast for the NERDvember, the first week of the month, that we did on time frame. Next time, we're going to be showing off a little bit, as I call it. And again, this all stemmed from a conversation we had with a client this week, actually, this past week. So we're going to be showing you some relative rotation graphs and some really interesting ways to rank investments and observe the markets. So if you have any questions, as always, feel free to reach out. If you'd like to schedule an intro call with me, like I said, head over to that website, click on that button in the middle. It says, see if you're right for us, and somebody will set up an intro call on the calendar for us to talk and discuss your personal situation confidentially, easy for me to say, at a time that works for you and in our calendars. So hope you had a wonderful day. I hope you're enjoying the fall weather, and we'll look forward to talking to you soon.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.